All right, all right. Happy Sunday, everybody. It's 12 p.m., April 19th. My name is Amal, and I have Faisal, our equities analyst, on the call as well. Welcome, Faisal.
Good to be here, man. Hope you're doing well.
Doing fantastic, doing fantastic. Um, so, folks, again, we are the original Cryptosomniac team. We have rebranded to our new community name, which is the Alpha Trades, because remember, we are now branching off into other asset classes, other markets, such as Forex, options, oil. We're going to try to include gold position updates too. I've been taking some gold positions, so I'll be including those as well. And Faisal, our equities analyst, he does daily live updates in this particular channel. So you get to see on a day-to-day basis how the market has opened, what his thoughts are through the day. And yeah, so with that being said, just like we have every Sunday these videos of equities catch up, today we're going to go over all the little things that happened last week, as well as our micro and macro picture of what we're seeing in the market. Okay, so first things first. All right, let's go over the numbers of coronavirus, because obviously that's an important data set that we need to look at to understand, where people are in terms of their mindset, how the country overall is looking, how the world is looking and grappling with this. So currently the United States is at close to 740,000 cases of infections, 38,000 deaths, and looks like we have a recoveries of about 46,000. Okay. Now, beyond that, Faisal, I wanted to touch up with you about what you thought of what happened with the numbers of the unemployment numbers last week, and what were your thoughts on that?
Well, first and foremost, I continue to believe that regardless of what numbers you're looking for, the market has already priced down that the unemployment could skyrocket to probably around between 20 and 30%. So those numbers that we saw last week, I think are still low. I think it's the number of unemployment is or unemployed is still going to go up. And for the most part, you may even see, just like we've seen in the past couple of weeks, the market ignore the news coming out and just continuously churn to the upside. I will say though, I think technically the market has, come to a level where I think it could pull back. My initial target was 2,900, between 2,900 and 3,000, but I think this 2,850 is really showing me something. And while the market did close above that 2,850, I think Monday will be very key, and I would not be surprised to see it open under that level, considering where it's at and how much of the news, not just relating to unemployment, but relating to, the stimulus getting to the right areas of business and how that's going on that front. There's a lot to take in. So the unemployment numbers is just one factor in a list of about 10.
Right, right. That's a great point. That's a great point. Um, Aside from that, I wanted to discuss this article that Mark Andreessen wrote. It's time to build. And again, for those of you who have not read this is actually on my Twitter, so you can go check it out. Basically, Mark Andreessen talks about the state of where things are in the world, specifically related to America, right? And he talks about why is it that we are in the position that we're in? How come we're the strongest economy? We tout ourselves as the richest country in the world, yet we were so woefully underprepared and unprepared for this pandemic, which some of the smartest people have been talking about for years. And not only that, how is it that we crumble as a society and as an economy in less than 1 month of this virus impacting us, right? And so some of the solutions that he talked about is, what we really need to do is, once we get past this, America really needs to get its shit together. If we were able to give out so much money so fast to all these people, right? Why is it that we have such a crumbling infrastructure? Why is it that we have such a bad healthcare system? Why is it that it only came to the point of collapse where we started to give out money to people who really need it. So I guess, I know you may not have read this article, Faisal, but what are your thoughts on this kind of information?
Dude, I think you hit it exactly right. I was always someone that uh, looked at when people wanted to bring up arguments about improving the healthcare system or drastically reducing student loan. Sure, you could say, what about the debt? Where are we going to get the money from? And I never really looked into into the exact numbers and how it would affect everything. I was just kind of like, okay, the solutions so far that we're hearing, it's either going to be costly, and once you start implementing those solutions, you don't really know how it affects it down the road. But what we're seeing now is like, it seems like the Fed all is waiting for was for a crisis to happen before they actually do something. And it's crazy to me that we still have all these underlying problems that could turn into potential crises, yet we are still in this notion where we only react when something actually happens and when probably it's too late. And so there could be long-term detrimental damage as a result of reacting too late.
Yeah.
As far as like, I just don't know. It really makes me question everything about what was possible and what was not, as far as things like student debt and healthcare, exactly what you said. So I don't know.
Right.
I can't wait to see how that reshapes, policy making in the future.
Yeah, yeah, that's a great point. Some of the more important points that Mark Andreessen touched upon was, how is it that we have some of the best universities in the world, some of the best healthcare systems, yet we're still failing the younger generation in terms of getting them the highest level of education, right? How is it possible that we have you know universities like Harvard, yet we have some of the worst high school dropout rates? How is it that Harvard having so much endowments? Why can't they take on 100,000 students a year? Why can't we have Harvard-like schools with the price of community-like prices or community college-like prices, right? So it seems like all facets of the economy are slowly coming about in terms of their true face, where we can see that all these things were significantly overpriced and we should have been doing a lot more. And maybe the conversation is more so about, did America become too complacent?
Yeah, I think that's a great point. Exactly. We just get so used to how the system is. And it's like when an event like this happens, it really shows you, damn, there's some real underlying problems. And you're exactly right. First of all, the cost of education should have come down right when there were alternative educational solutions like online courses, like the facets that you get information from opened up when the internet, as the internet, built out. So really, I love that point that you make, that these schools get 100 billion or so much money in endowments. Why can't they be the same prices as community colleges? They could definitely take the hit, and they'll probably still get a ton of endowments.
Yeah, exactly. And there's some other points that were really interesting. Um, One thing being, why are we not seeing, more factories across America that have, state of the art facilities where they can have, what do you talk about? Why aren't we building Elon Musk's um, alien dreadnoughts, where giant, giant gleaming state of the art factories producing every conceivable kind of product? You know, um, why are we not having transportation like supersonic aircrafts and millions of delivery drones, high speed trains and monorails and hyperloops, and yeah, the flying cars? I mean, we talk a lot about America being this amazing society, yet we're not really that much more different than other societies because we have not had the kind of advancement that we would always dream of. So this goes back to the point of, if it only takes a crisis to really like start paying people, the money that they really desperately needed to uh, just, get by, how is it possible that we're ever going to accomplish these amazing things in society where millions of people could actually take advantage of these things, right? And again, it goes
Hmm.
back to the point of complacency is, you know, if we cannot, and this is a really great point too, where Mark Andreessen mentions, Nicholas Stern He says that, capitalism is how we take care of people we don't know, right? And obviously, people we don't know in America is just people who are doing the menial jobs, whether they're, people who are delivering for you, whether they're, driving around their Uber, etc. Right? These are the people who should be actually taking advantage of these kinds of systems, or rather, they should have the money to be able to take advantage of these kinds of systems. And if they cannot, that means we as a society are failing.
Yeah, that's a great point. Capitalism is really the economic structure of the winner and loser. There will be winners, and in this system, there will be few winners and a lot of losers, relatively speaking. So you're exactly right. We like technological innovation will come. We will get something like, delivery drones everywhere, high-speed trains, hyperloops. But with the way society is shaped today, it may seem like you're exactly right. The product may never come for the masses, and it may
Yeah.
only just come for, the select few who can afford it.
Right. Yeah. Yeah, that's a great point. Now I guess I wanted to now tie this back into the economy and where we are, right? So far, I mean, obviously you've mentioned that everything that you may be seeing in price action right now um, is pretty much factored in, whether it's the unemployment rates, whether it's more and more businesses um, potentially declaring bankruptcies, people not being able to pay their mortgages or defaulting on their loans, etc. Right? And even this morning, I think we just saw Neiman Marcus was declaring bankruptcy. I think that was something that here it goes. Neiman Marcus is planning to file for bankruptcy as soon as this week. So we're starting to see sort of the ripple effects of not only what the coronavirus caused, but rather the overall larger effects of what this economy was headed towards, which was, you know, um, online distribution, online consumption of goods, people like your age or my age who don't really shop that much at retail brick and mortar stores, right? And I'm obviously someone of the opinion that every crisis like this goes through a cleansing process of the economy, whether you're over levered hedge funds or you're higher debt companies, or you're just not able to compete as a company in this kind of environment. All of those typically get cleansed out. And so what comes after the cleansing is by far the most important thing. How we as a society decide to build, as Mark Andreessen said, is probably going to be the most important thing. So I guess my question to you is, in your vision, when we come out of all this, right, what do you see sectors of the economy evolving or advancing, and what sectors do you see potentially fading away, into the darkness?
That's a great question. So to start off, I thought I kind of had an understanding as far as small businesses were going to get affected the most and they would start seeing bankruptcies a lot faster. But the Neiman Marcus news this morning really surprised me because that was one of the, one of the bigger ones that does have an online business, that does have some cash behind it, that is really saying, hey, things are not looking good at all. We're weighing bankruptcy. I don't think it's official, but they're weighing bankruptcy at this point. I think that was just a shock to me. And so coming out of this, like you could have the whole retail landscape change. You'll have a bunch of commercial lots that will be available, whether Macy's no longer operates there or other clothing stores. Like you said, if you don't have an online business, it is really, really tough because you just aren't unable to generate foot traffic. And the timeline, if you're going off pre-coronavirus numbers, the timeline to get back to pre-coronavirus numbers is indefinite at this point. Even after we get the first vaccine, I know there's a lot of people that aren't going to take it. There is going to be some people that are skeptical about it. And I think you are going to have the psychology of people not going out and shopping at brick and mortars stay in people's minds for around, 1 to 2 years, maybe at most 5. Like that's the
Yeah.
most I'm going to give it. So you could just see the economic landscape transform in the sense that you will see a lot of empty buildings, people who did not pay their rent, and whether they were retail stores or restaurants, those are also another area that's going to be affected big. Event driven places like we have something called I forgot what it was called, but it's just like an event driven play.
Live Nation?
No, not Live Nation, like a main event type thing. Kind of like an arcade Dave and Buster's, like Dave and
I
Buster's
see, I
is
see.
done. Maybe even gyms will be. I think I saw this week that 24-hour fitness is weighing a bankruptcy as well. So you're having a lot of these businesses that are very, once again, debt reliant. They're just unable to manage, and I feel like this thing is not even like played out yet. Like we're still in maybe the early innings as far as getting through the virus, not pertaining to the market getting through the virus, but the virus itself and consumers getting through it. So it's really troubling to see all these big businesses just kind of start to fall to the wayside. And I don't even think the market has priced in the oil collapse that could be coming soon. So there's a lot of risk still, and how that ends up changing our entire economy and the way we walk out and see the world remains to be determined.
Yeah, that's a great point. I wanted to unpack some of the things that you said. So, number one, obviously, with the way the retail industry is heading towards, which is ultimately bankruptcies, right? What we're really starting to see is, what I mentioned earlier is a shift overall in the consumer mindset, right? I mean, obviously, the consumers, most people that I know, even my parents or maybe even your parents, you would probably say that a lot of people pretty much shop online nowadays, right?
Mm.
And so that could be, obviously one of the larger catalysts for these businesses being pushed out of the market. Number two, obviously, we can say that online businesses like Amazon or online retailers themselves, maybe those are the ones that are also crushing these businesses a little bit. On top of that, as you mentioned, a lot of these businesses were actually heavily debt ridden or over levered in terms of whatever money that they were borrowing from banks just to keep their day-to-day operations going. Okay, now all this sort of ties into the economy, where we start to realize that, okay, well, it's only been month and a half of the virus itself, and yet so many of these stores are already getting crippled. Then if this thing lasts a little bit longer, how much could things get worse? And then you factor in what you mentioned about oil. Well, oil is another industry that's really suffering from what we're dealing with right now. So it's a cataclysm of events that are all showing you that, hey, number one, we, as you mentioned, are pretty much in the early innings of this virus. We're just now starting to see reduction in rates of infections and deaths, yet we're actually already starting to plan the party of, hey, let's get this economy back and started already. So it's like before we've even solved the problem, we've already pretty much assumed that we've already solved it. And so while doing so with this, premature opening of the economy, we could actually exacerbate things and make things even worse for even the companies that are well positioned, because the well positioned companies right now could potentially last, 3 months, 6 months, maybe even a year without the kinds of revenue streams that they're seeing right now. But even they will start to, get hit if we actually reopen the economy too early. And then you start getting into the oil price action, where we've now seen about 18.44 as a close this past Friday. And I read that under $30, I think 61% of the companies are actually solvent. So that means already, about 39% of the companies were insolvent under $30. And now that we're at under 20, I cannot even imagine the kind of pain that oil companies are seeing. And then the oil companies that have debt exposure on banks such as Citigroup and Wells Fargo, and I can't think of the other names, but point is, you could see this rolling effect slowly play out. And it seems like we're already celebrating the victory. Do you think that's wise? Or I guess like what's your opinion based on, what you're seeing in Houston?
In Houston, oh man, it's still a little nonchalant, to be honest. People want to go back. Um, I know my city. I know how the people feel. People do not take it as seriously here as in other states. Um, there's just this angst to get back. Like the people who are healthy, the ones that are anxious to get back, they're like, I'm healthy. Nothing is gonna bad is gonna happen to me. It's really gotten to that point where either people just need the money that bad that they want to go back to work, or they want to get their lifestyle back in order. But yeah, I think Texas said that they're going to reopen the economy, parts of the economy next week. So I'll kind of see what that's like, and hopefully I'll keep you guys updated on what that soft reopening is like. Because if Texas ends up getting successful from it, and hopefully, God willing, no increase in cases, or the curve doesn't start to shoot up, more states could end up following the soft reopening, and that could end up, somewhat strengthening the economy, at least from where we are now.
Good point. Yeah. And by the way, folks, those who are watching this right now, please hit the thumbs up, hit subscribe. Faisal and I do a lot of free content. We do a lot of equities content for free, and I myself do a lot of crypto content for free every day making these videos. So a thumbs up, a comment left, or a subscribe button hit is a huge help to us who are trying to grow this channel and give you guys more free content as much as we can. Okay, you could also find us on Medium right here, Alpha Trades, again, as we've rebranded. And you can look at our articles that are in written format if you don't like watching these videos, or you can hop on our Trading View analysis, where we also have written analysis, as you can see. The Alpha Trades is where you can find us. All right, so going back to the numbers, okay? So let's start breaking it down sector by sector, okay? So one thing that I wanted to talk about, Faisal, is obviously, it makes sense that in this particular state of the economy, that the mortgage demand is, completely being crippled, right?
Mm-hmm.
Now, if we start looking at, mortgage demand as well as the housing and construction chart right here, ITB right here, what are your thoughts on, what could potentially unfold in the housing market as well as the real estate market?
Well, there is so much uncertainty, that's for sure. But look at that steep drop. I mean, it went literally from 50 to 22. I mean, in the span of 2 weeks. So
Yeah.
at this point in time, I already know that it's going to be bad. But when you see a 50% drop, like, everyone knows it's going to be bad. So at this point, I'm kind of thinking, okay, obviously the market is priced in the fact that people are not going to be going out and buying homes and all this stuff. But I still think, because the market is not priced in the whole oil glut and the bankruptcies that are going to come from that, those are a lot of middle-class buyers that are not going to be shopping for homes because there's too much uncertainty with their job. So I still think that while we did see a huge drop in the housing sector, I think we're looking at ITB right now, there's a big chance that we could definitely test the lows for this sector, and definitely break the lows, because if oil continues to go down and we start to lose those really good jobs, the energy sector has a lot of good middle class jobs. Um, you could definitely expect the housing sector to see significant damage for the medium term, until that whole space starts to clear up. And not to
Yeah.
mention, that's just energy. We're starting to see big gyms like 24 hours and big stores like Neiman Marcus close. I don't doubt that there will be a lot more closings that are not expected within the next month or so, if this thing does not start to clear up, or something significant doesn't happen on the positive side.
Yeah, great point. And I'm glad you mentioned oil, because one thing that our viewers need to understand is oil is actually a huge part of global economies as a whole. Okay. It contributes about 8% to the American GDP, and it employs about 8.5 to 9 million people just in America. And so last week we saw 22 million total over the last month, people being unemployed. So last week, I think the numbers were 5.5 million. The previous weeks were 6.5, 6.2, and then the one before that was 3.5. So all in all, we've now seen about 22 million people unemployed. That is 14% of the total labor workforce. Okay. Now you start talking about oil, and because it already has, about 9 million people unemployed, or I'm sorry, 9 million people employed, you could start seeing a significant damage on the economy like we've never seen before, because oil itself is now the largest pretty much factor that is dependent upon the economy moving. And if you don't see the economy moving soon, oil itself is going to crash more and more because there's really no demand. There's tons of supply out there, right? So the rolling effect of oil prices being crushed is drilling companies and refineries shutting down and more people being unemployed. So the point that I wanted to mention about oil is that it is a huge factor in understanding how it's going to impact the overall economy. So make sure you guys pay attention to what happens to oil. I know on the Advantage side, Faisal gives really great updates on what's happening in the oil sector right here. So make sure you come join our Advantage community, and you can understand what's happening in the macro equities markets as well as the oil markets. So Faisal, going back to now the other sectors, okay? So we talked about semiconductors earlier, right? What are your thoughts on semis?
Well, they continue to be one of my bellwether sectors. So their performance is probably in the top 5 of most important factors when determining whether or not the market is healthy or wants to go up. Because they have a lot of part to play in the future growth cycle of the United States as far as developing new technologies in 5G, AI, and virtual, VR, everything. Semis will go into everything. So there will be a growth path there 5 or 10 years down the line if the technological innovation continues, which it does look like it will. So considering that, I really like to look at SMH. I love to look at AMD. I've been saying AMD for the past year, 2 years, that AMD is still the strongest semi stock and probably one of the only semi stocks you need to watch. AMD, NVIDIA, you could watch the other one. It's kind of like they do the same thing as AMD, but AMD is really a great company. As you can see, though, it's kind of gone up really nicely, has yet to break out above its top. So I'm really waiting to see if it does. My personal opinion, I really don't think you're going to see any of these semi stocks break out because I think this is close to where the market will sell off. And I think as you start to see throughout this week, if AMD cannot get above that hump, even if the market continues to go up, that will be one key sign that'll tell you, okay, the strength in the stock market could be faltering because one of the leaders in one of the strongest sectors is starting to show some weakness. And if the market definitely starts to go up and this stock cannot break out, that's a terrible sign because this stock has been one of the best stocks that's gone from 37 to $56 in 3 weeks. And it still has really good estimates, really good growth trajectory. So it should break out if the market's going to go up. So I'm really going to be paying attention to AMD this week and semis overall, SMH. I should see that sector break out as well. I'm also looking at a lot of high growth sectors, but specifically there's an idea that kind of happened this week or that kind of popped in my head this week that I just wanted to share. So I think we may be in the middle in terms of performance. We may be in the middle of a rotation into more value-oriented names and out of more maybe growth-oriented or maybe even tech names. So I want to take a look at Amazon, Walmart, all the stocks that you've been seeing have been skyrocketing like crazy. It's crazy to see this. And, you can say, sure, okay, Amazon's one of the core businesses in this economy. Of course, it'll go up. But you take a look at a company like Chewy.com, CHWY. Why? Yeah. Look at that stock. Same thing too, huh? They are an online business, so people are are rushing to buy them. But I will tell you right now, this business is terrible. It is a terribly, fundamentally terrible business. I cannot believe they got it above its IPO. I mean, the high of the stock was the IPO. It was doing absolutely terrible since then, and the fundamentals, it completely deserved it. Not only that, Amazon said that they were going to get into the or pet food delivery market. Chewy delivers pet food to people in the United States. And so when Amazon starts to move into your business, that's not a good sign, especially when
Yeah.
they can literally mirror your business. It's an e-commerce platform, pretty much.
Right.
And so for me to see that stock go up to all-time highs and break out the way it did, that tells me there is a lot of complacency and a lot of people just chasing stocks, whatever works. And when you start to see people chasing things to the point where like a stock like Chewy.com went up 30% in like a week or something like that, or 30% in 2 weeks, that's a really big warning flag. That was the first warning sign at the end of the week that told me, okay, I really think this market is getting overheated at this point. But back to my original point on the rotation out of value or out of growth and into value, the market could still go up. Now, while I don't think it will, there is a possibility that we could see sectors like financials, energy, industrials, things that have been bogged down because of this virus. Now that the risk is starting to clear up at least a little bit for the near term, you could see money move out of these high growth sectors that have maintained their value and in some cases gone to all-time highs, and move into the more value-oriented sectors like financials and energy. Like we saw Friday, financials, energy, and industrials, all three sectors which had been lagging the most over the past month or so, they had one of their best days, and I think they continue to show positive momentum despite all the negativity that comes out on the coronavirus side. So
Mm-hmm.
I'm really paying attention to these three sectors: XLF, which is for financials, XLI, which is for industrials, and uh, I'm sorry, what was the, XLE, which is for energy. I want to see if this market really wants to go up at this point. You will definitely see a lot more buying in these sectors, because now I think the market leadership is starting to wane a little bit. You saw on Friday Netflix kind of come down 3 or 4%. Amazon came down. A lot of these stocks that had been taken up to these highs were starting to come down a little bit, but you saw kind of money move in from these stocks into these financials. Look at JP Morgan up 9% Friday, EOG up 15% Friday, even though oil was pretty much like flat. Like oil was not up that much, and you had oil stocks like EOG, Chevron up 8-10%. So that's two sides I'm playing. I really think this week is one of the most important weeks if you're thinking about investing in the market, or if you have things in the market. You really need to watch a lot of these key sectors, because I think the move could happen very fast. As far as if you've had winners like Peloton, Zoom thing, your value could be taken away like that, and that value could instantly go into one of these more value-oriented sectors like financials, into a stock like JP Morgan or Citi. But if you don't see that happen, be prepared for the market to sell off, because I personally think the market still has more to go. I know, Amol, you think the market still has more downside to go because the risks have not cleared up to a good level, in my opinion. And I think reopening the economy actually adds more long-term risk. So keep on a lookout for that. There's a lot of mixed signals in the market. And I think this week it'll be a very fun week that, even though we're in the second week of earnings week, I literally am not paying attention that much to earnings at all. It is all about performance at this point. We've already seen what banks have done last week. Now it's time for them to show us some performance.
Yeah, that's a fantastic point. And I'm really glad that you mentioned it the way you did, which was, look out for these particular areas to break out. I wanted to expand upon that. What are some other growth to value stocks that you're looking at? So, for example, you mentioned AMD. Now, would that be considered growth or value?
At this point, well, it was more value. So 2 weeks ago, a month ago, at this point, it's still kind of like a high growth stock. Like, just because it's been 2 weeks, the value has changed by 30%, 40%. So you have to say, okay, it was a value stock 2 weeks ago, even though it's been just 2 weeks. Like, it's not a value stock anymore, even though it has the same exact product line, the same growth trajectory. So I think the risk, the buying it at these levels is buying it to where you think AMD can still have a solid year despite, you know, semiconductor demand, I think, is expected to be down for the overall year, but you're probably expecting, you know, it to be flat or something, buying it around this price.
Yeah.
So that's what I would say. I think a more value, like more growth oriented, would be something like an Amazon, something that's already broken out. Like you look at Peloton, you know, a stock that I was really short on. I had to thank God I got out, because this stock has just been
How do you spell
absolutely on
Peloton?
fire. PTON.
Oh, PTO, and there it is.
I mean, this stock has literally been on fire as far as the same thing that I talked about before. People chasing just the basic ideas of what they think will work. Like even though Peloton, I don't even think it'll work. The fundamentals look terrible. People don't care about them. When people don't care about fundamentals or estimates or anything like that, it's just a pure sign of chasing value, chasing what works. And I think buying it at these levels, you're buying it at the highest premium when the hype is in.
Yeah.
So determining what is value and what is not, I think, is less so based on fundamentals and more so based on relative price performance. Because even though the banks, energy, and industrial still have a lot of risk, their relative price performance has been extremely low. And so in that case, you have to say that those stocks are the value stocks. And even though Amazon is trading at all-time highs for one, but it has an extremely solid business in this environment, you have to consider it a growth stock, considering it's just gone up so much. And at this point, you're buying it at a very high premium when you're expecting, like if people start to lose their job and money starts to be tighter, I think Amazon's business will come down, you know.
Yeah,
I don't
definitely.
expect it to be the king forever. Like people will end up getting hurt more so as this thing gets extended. So I
Right.
think you got to look at price performance as a way to determine what's value and what's not. And as far as secular performance, so you really try to dig in there. I think the most extended sectors are tech and healthcare. But you know, the most valuable sectors, in my opinion, are financials, energy for a short period of time, and then industrials. So I like Parker Hannifin and the industrials, PH. They're a diversified industrial conglomerate. They do a bunch of stuff. You see this stock has not, compared to a stock like AMD, even though Parker Hannifin is a great company, very well managed company, one of my favorite industrials. You would think with how much AMD has rebounded, the stock would rebound a little bit, but it remains to be seen. You know, the money could still go into value, and this is where I expect the money to go if that value cycle were to be confirmed. So that's just a little taste. I hope I didn't lose any people as far as explaining how the rotation is expected to work, but just keep an eye on those specific sectors. If tech and healthcare take a break, look for money to go into energy, industrial, and financials.
Great point. Great point. No, I'm really glad you mentioned it the way you did, because I think understanding how valuations can get out of control for specific stocks, even some of the best stocks, they can get pushed to unforeseen heights, even in an environment that doesn't really make sense. Even though the environment could be conducive for the business, like for example, Amazon, doesn't mean that Amazon should be, busting out so much. I don't know, right? Because obviously, like this is the phase of euphoria where I think, as you mentioned, people are really chasing the gains. And if you start looking at AMD, like you mentioned, right, it's pretty much come back to the same point where it dropped off just about a month or two ago. So really, if you're buying right now, you're effectively just buying resistance, and given not only in terms of just technical resistance, you're essentially buying with the idea that you've already wasted, the 30-40% move back up. And now, given the macro situation of the economy, as well as how things could unfold over the next several weeks or several months, you're pretty much buying in the dark, right? So
Yes.
I'm really glad you mentioned things the way you did. So again, just to recap, you said XLE was one ETF that they needed to watch.
Yeah,
What was the other ones?
XLE, XLF, and XLI. So those are the ETFs that are based on the sectors. So industrials, financials, and energy. Those are the ones that I watch. They're pretty big ETFs, so they have a lot of volume. They're pretty good indicators from in my experience.
Okay, great point. Okay, perfect. Now let's dig into some more sectors. And I'm a big fan of Stanley Druckenmiller, and I think you are too, correct?
Yeah, definitely.
Yeah. So one of the things that Stanley Druckenmiller talks about is he looks at three aspects to an economy where he understands truly the health of the overall economy, and he calls it the internals of the economy. And those sectors are XRT, which is the brick and mortar retail ETF, IYT, which is actually, I'll pull these up. So XRT is the retail ETF, like I mentioned. IYT, which is the transport ETF right there. And then IWM, which is the small cap Russell 2000 index. Okay. The index ETF. So all of these, if we look at these separately, right? So let's start breaking these down. XRT, let's put that up here as well. And then let's put down IYT. Okay. Now, the reason I wanted to bring these up is because, one thing we have to understand is these are the key ETFs where we get to see what exactly is happening in terms of movement of people, which is transport. How exactly is the retail economy doing, which pertains to consumer confidence, which is particularly important in an environment like this. And then IWM, which is relation to small businesses, whether it's in America or abroad. Okay, so when you look at these three, Faisal, I mean, how exactly, I guess, do you see their strength or weakness?
Well, first and foremost, all three of them, it's interesting that you pull them up. So the transports are in the industrial sector. So the industrials, like I said before, have been one of the biggest laggards. So that makes sense why they kind of look so bad. It's not a good sign when your transports are not doing good, because that means economic activity is probably down. But at this point, that's probably priced in. I don't know if I can make a good read on whether or not enough has been priced into the transports. As far as retail continues to be a selective game. Only a select few win. I think the majority still have the biggest risk of bankruptcies and a lot of financial problems, to say the least. So reading, kind of assuming retail to be an indicator of the overall economy, I don't know if I factor it as much. You have companies like Amazon that are just totally controlling the market, and then you have companies like Gap, they even go under at the end of this. So it's a mixed bag as far as how retail will overall affect the economy. But the small caps, I think, is the biggest one that I pay attention to, because they have the most at risk as far as their entire growth system changing from where it was before. So before this crisis, I think it was, if you had a great idea, it was fairly easy to get a loan, and you could have a good interest rate with that loan. Interest rates are relatively low from where they were before. But now, after this crisis, I think there'll be a lot of changes to who gets a loan and who doesn't, and how exactly debt is spread out, and who exactly can acquire debt. And I think that will really affect the small businesses the most. So they have the most to lose in the long run. So I'm constantly paying attention to the small caps. And, the way I see it, they're not showing me that much strength either. They've gone up a little bit, but they're not really going up like an AMD or anything like that. I wish they would. That would give me a much better signal on the economy, but they're really the biggest underperformer as far as indexes are concerned.
Yeah, that's a great point. And going along with your thought process, I saw this from Bloomberg stating that, so far larger companies such as publicly traded restaurant chains receive big amounts of government's lending program, while smaller businesses like neighborhood eateries as well as hair salons were pretty much locked out. This is actually sort of been front page news of everything that I've been seeing across the board is smaller businesses have really gotten the lower end of the stimulus. I was reading some data about, for every dollar that the stimulus created, 3 cents of it, okay, 3 cents of every dollar went to your average American taxpayer. The 97 other cents actually went to corporations and small businesses. Now, obviously, if we're looking at 97 cents going to corporations and small businesses, of those 97 cents, it seems like, we could factor down maybe 85 or so of those cents towards corporations, larger corporations, because what everything that I'm seeing across the board, it seems like small businesses are really, really suffering. Some of my friends who live in New York, some of my friends even, in California or Colorado, all across the country, they're talking about as they walk out into the street, into their neighborhood, whether they're going for a walk or a run or taking out their dogs, they're seeing the favorite places that they used to eat shut down. They're seeing, their local hair salons being shut down. They're seeing, their neighborhood pub or bar being shut down. And these are places, I think the data was that 1 in 5 restaurants going forward are not going to ever come back. They're permanently shut down. So the case is being made that overall, small businesses are getting the bad end of the bargain. And if that's the case, then of course we can see that being factored into maybe the IWM index. I'm not saying that this is already priced in, but overall, maybe the economy itself, the real economy we already know, is completely disconnected from the stock market right now, because it seems like every time unemployment numbers come out, the market actually goes up, which is pretty nuts. But I know you mentioned that it's very possible that the numbers are completely factored in, but I can't imagine that the market is fully capable of understanding at how much damage the real economy, when it comes to unemployment numbers and small businesses, have suffered. I just don't believe that that's factored in.
Man, the market it's a smart dude. I'm telling you, when it dropped 30%, when it had that historic drop, that was telling you we were about to witness something we have never witnessed in the real economy. Because the stock market just told you we were going to witness something that we've just gone through, something we've never gone through since like the Great Depression or something like that. So you knew something crazy was going to happen in the real economy. And I think as the real life timeline has caught up, the market had already discounted that. But I still, like I said, I don't think the market has discounted everything. And I think it gives people false hope. People get in at the wrong time. And I think at this point, if, the uptrend that we've seen in the past 2 weeks, 3 weeks is just all part of the same, like an overall down cycle. I don't think a V-shaped recovery is real. From the crisis that we're going in now, it's not possible. Yet you're having some of these assets like AMD do this extreme V-shaped recovery, even though they don't have advantage businesses like Amazon. I mean, sure, you could say graphics card demand is probably up as gaming is up, but to have the stock trade at pre-coronavirus levels is very surprising to me. But
Yeah.
go ahead.
No. So one thing I was going to mention is as for technical levels, we're obviously approaching the key golden pocket 618, Fibonacci level, which historically, in most assets across the board, is a very well respected level, whether it's professional traders or algorithms, right? And so we're about, I guess, 60, 70 points away from that level. So I guess, I could totally see going along with your point that at some point, if in this particular week, it's a do or die scenario, right? And we're going to understand if the market is going to want to keep pushing up, or we're ready for, potentially the next phase of a sell-off. And that sell-off doesn't necessarily mean that we have to put in a lower low. It could very well mean that, we could retrace back to this level right here, maybe 2400s. And maybe, if things get better in the economy, then we can, grind back up.
Yeah, I completely agree. That's a realistic scenario.
Yeah. And So one of the questions that one of our community members asked is, can you cover something similar to these bear market rallies that we see in relation to previous bear markets? So I can definitely do that actually, because I mean, one thing that you and I have been pretty spot on about is understanding to keep bear markets um, in perspective. Rather, don't think that number one, we can just V-ship recover out of here. It's possible, but is it likely or probabilistic? Not necessarily, given what we're seeing in the economy. And number two, if you look at historical data, I mean, we've often seen, like even in the 2008, 2009 financial crisis, we've seen, big drop, chop around here for a couple of weeks, another drop, chop around a couple of weeks, and then you make your final leg down. Even in the early 2000s, right? You can see the 2000 tech bubble that popped. You can see internally we make, couple weeks to the upside, drop some more, a couple weeks to the upside, drop some more. This is very common in bear market rallies. This is where people start getting hope that, hey, it looks like the market's coming back up, and then you get, shot down. Looks like the market's coming back up, and then you get shot down some more. And so the one thing that I wanted to mention to some of our viewers is it's usually around the 50% of the 618 area is where you really start to question, wait a second, like, am I wrong? Could this thing just keep pushing back up? Maybe I should FOMO and buy into stocks now because they could keep going higher, right? I guess, what is your piece of advice for those who are really feeling that FOMO, set in?
Oh man, if you're feeling FOMO, just don't. Okay. Sure, you may have missed a little bit, but I think buying here at these levels I think it's definitely a mistake, especially if you're buying for the long term. I think there's way too much risk left. If you're thinking about buying a stock that's down 20% when it was down 40%, a couple weeks ago, and you think it's gone up a little bit and you missed out on that 20%, just wait it out. I tend to think that I'm not so much on technical levels as far as, that golden pocket. I really think these sell-offs are somewhat catalyst driven. And it's weird because I think it's kind of like an inverse catalyst. So I think the news that we got Friday, as far as the government saying we're going to reopen, or the economy will reopen sometime soon, or at least Texas is saying we're going to reopen the economy, things supposedly seem good. And I think when you get events like that, where even though things supposedly seem good in the near term, but it could definitely add risk in the long term, I think that's what I'm looking for to say, okay, now here comes the last round of optimistic buyers. And I think at this point, that's why I think next week is really going to sell off. At that point, that's when the sellers come in and say, okay, the optimism is over, the euphoria is over, time to get back to reality. And, just as people, this week, as we've seen the market go up, news always reports on the positive news to kind of affirm the market. But just watch, as soon as the market goes down, this week or next week or wherever, it'll be back. The news headlines will be, oh, this many cases, but it'll be back to focusing on cases, which will drive people crazy because it was like, okay, you didn't even value cases 3 weeks ago when the market was going up. But I just want people to be aware of how, to be open-minded on how the news will change and how, during this last couple of weeks, it'll get people optimistic and pump them up, get them excited for the market, drive it up a little bit, only to sell off in the next couple of weeks, just as the news seems to be going optimistic.
Yeah, that's a great point. I was actually trying to find an article that was going to relate to your thought process, but I can't seem to find it. But one thing I did want to talk about is two things. Okay. Number one, emerging markets and their outflows. And number two, obviously we talked a little bit about oil and its impact on the market. But how do you think that, oil is doing in terms of, its overall supply and demand? Do you think that the OPEC deal last week was, or I guess 2 weeks ago now, was pretty much factored in? Or do you think that oil is going to pretty much start surging as soon as the economy opens back up?
Oh, that's a great point. Yeah, I think exactly kind of what I think will happen in the stock market this week is what happened in oil. As soon as we got that deal that was supposedly positive, the oil market just completely sold
Yes.
off and said, nope. It, I still think it sold off because not just because the deal may have been priced in, but because the overall demand still remains a mystery. The supply side continues to just be a whole mess as far as storage is concerned, and so what if you're cutting supply? I mean, no one can really buy if they can't store it. So there's like just it's just a whole mess of rebalancing and balancing. That's why oil is so tough to trade right now. If I'm looking at tech or oil a lot, I'm usually looking at technical levels, not so much playing on catalysts or events or anything like that. But the supply cut is good. I think it creates a floor for oil to an extent. Like I think we're closer to the lows than like I don't think the lows of U.S. oil are going to be somewhere like $10 or $12. I think it'll be maybe 17, 16. I think are we trading at 18 now or 19?
Yeah,
I
I think
think
we closed last week at 18.44.
yeah. So I think the floor is close. That's what that cut does. But the demand side is so uncertain it could cause some people to wait on buying oil, or some countries to wait on buying oil, and then the supply or the storage is another issue. It's just a whole mess, honestly.
Yeah, that's a great point. I'll touch upon the emerging market outflows. So this was the article I was looking for. Here's the EM markets showing a lot of money moving out of those countries and those economies, and potentially either being repatriated back to America or potentially just residing abroad in cash. I think one thing that we have to understand about the environment right now is risk on versus risk off. The risk on environments typically are, exactly as the words say, risk on, meaning that you're more inclined to take a risk on your money when you know the overall uh, structure of, whether it's your local national economy or global economy is doing well. When you start to see things go bad, whether it's your national economy or your global economy, you're less inclined to take those risks. So this is why one of the reasons why I mentioned that Bitcoin is a asset that is only going to do well in risk on environments, because no one wants to touch a virtual currency that really isn't used a whole lot in an economy that's looks like it's about to start cratering even more, right? I think
Mhm.
people much more care about whether they can put food on the table, if they're going to have jobs tomorrow, what could they potentially do to just survive? And whether it's things like Bitcoin or other assets or asset classes like emerging markets, you're going to see a lot of outflows pour out because that's the natural human tendency, especially for investors. You don't want to be taking risks on your money when you know that things are not going well in your local national economy, when you may need to I don't know, give money back for investors who are asking for redemptions or et cetera, right? So the point about emerging market outflows is that, just to wrap it up, is currently we are in a risk-off environment. So even though you might see Amazon performing like a risk-on asset or AMD performing as a risk-on asset, overall the market health does not say that. What we're really in is a cautiously optimistic phase. So this is just something to answer to our member who asked that question. The other question that another member had is, where do we trade Forex, gold, and oil? So I pick up gold ETFs on Thinkorswim, TD Ameritrade. You can actually buy the what is it, Zhao, I think, on Oanda. I'm pretty sure. Yeah, so you could buy gold right here on Oanda. You could buy oil on Oanda as well, if I'm not mistaken, but don't quote me on that. Oh, yeah, you can right there. Okay, so West Texas oil right there. You could buy that on Oanda. Oanda has a 30 to 1 max leverage. That was the next question. And then Forex, same thing. I trade on Oanda. Some of our Forex trades have been going really great as of late. And you and I were talking about this a little bit faster. It's been incredibly easy. I wouldn't say trading is easy, but rather, once you start to understand the pieces in the puzzle of what's being impacted versus not, you kind of just follow the pattern and you keep following along. And the best thing for me in terms of Forex trades has been recently is that all I do is pick up emerging market currencies against the dollar, meaning I long the dollar against emerging markets, or I short emerging markets against the dollar. So South African rand has been pretty good for me. Dollar franc, I had a couple of trades on franc. Some of them went well, some of them did not. And then Aussie dollar, so shorting the Aussie dollar against the US dollar has been pretty great. So these are the things that I trade specifically on Oanda. And then dollar yen as well. That's been a pretty great currency. So yeah, let me see if there's other questions. So another member asks, I'm looking to buy crude oil, and is there an option for ticker of oil, which is a product weighted, the ETN? Can you touch base on what ETNs are? Faisal, are you familiar with that?
ETN? No.
Yeah, I don't know what that is either. Oh, actually.
Is he talking about ETN, the Eaton stock?
I don't know. I don't think so.
That's an industrial company. I don't think that's I don't know if they have like an oil segment, but they're mostly industrial. So I don't know.
Yeah, we'll have to get back to that question.
Yeah,
we'll have to get back to that question. But so last but not least, obviously, we have to touch upon bonds. Okay, of course, bonds have been, some of the leading indicators in helping people understand how the underlying under the hood of the economy does, what, especially in times of turmoil, when big crashes like this happen. So I guess, what are your thoughts on how bonds are looking right now? Especially last week we spoke about LQD, HYG, junk, and then 10-year Treasury notes. So what are your thoughts on those?
Well, I think 2 weeks ago we had the Fed come in and say that they were going to back investment grade bonds and maybe buy some high yield bonds if necessary. So that was one of the biggest news to the credit markets because bottom line, it provided so much liquidity just off the bat. And so as you saw, the HYG, JNK, and LQD, all of them rose like crazy because the Fed pretty much eliminated a ton of risk and put a floor on all these assets. So coming into last week, I was really expecting them to continue their uptrend and to see if they would end up, breaking out above their highs that they had before the coronavirus. And while they kind of stayed, I think they closed mostly on the upside. They did not end up breaking out, which was surprising to me. So that continues to puzzle me a little bit, and I hope that I do not start to see them break down, because I think that would really that would really tell me that there's something serious wrong in the economy that was not priced in before this week. That's the one thing that should not happen. Bonds should absolutely not break down. I'm really surprised to see them not break out, but that's one thing you have to watch every single day. If you start to see bonds break down, I think no doubt you'll start to see the market get rocked. Because like I said, bonds have some of the most have had most of their risk eliminated. Like they have a floor, especially investment grade bonds. They look so attractive right now with the 10-year going down and yields going down. Investment grade bonds are probably one of the best things you can buy right now, in my opinion. They're probably one of the safest things because they're backed by the Fed. I think that's basically my take on it. Is I was very shocked to see basically no movement at all after such a big move by the Fed. Yeah,
that's a great point. I think this again, ties back to your point of, this next week is going to be a very important week because we're also coming fairly close by the end of next week, fairly close to the month end. So we'll have to, see how the month of April did compared to the month of March. And I think at the end of March, I think you and I spoke a little bit about rotations of equities into bonds, right?
Mm-hmm.
And I think most of that should have already completed. And I think if investors are now hedged into bonds versus equities, and then you start seeing bonds start to go down, I think more than likely, as you mentioned, I mean, then you're going to start seeing something really, really wrong in the economy that clearly the market has not, factored in. And then shit is about to really hit the fan. If you think last month was bad, the upcoming summer is going to be really terrible.
Yeah, I mean, I don't know if it's going to be as bad as before, but it's definitely will be something that does not make sense in this market. Like when there's so much uncertainty in the market, there's one thing that makes sense is investment grade bonds should go up or should hold flat. If you see them go down, LQD, that is like, I think that'll be one of the first signs, the first big signs to tell you that this market is ready to come down hard. So, I mean, you see how flat
Yeah.
it was. You see the huge jump it's had over the past, kind of has been since mid-March. But, I mean, the huge jump that
Yeah.
it made last week was as a result of the Fed saying that they were going to back these bonds. In this market, there's very little assets that have this low of risk. So just keep an eye on that for this week.
Yeah. Yeah. Well, on that note, I think we can pretty much wrap it up. Is there anything else that you'd want to talk about?
No, I'm good. I think we covered a fair amount. I'm ready to see what happens this week. It's just such an uncertain week. We could get a huge spike up or if we break through resistance, or we could really see some massive selling
Yeah.
as soon as tomorrow, in my opinion.
Last but not least, Faisal, this is something that I do want to talk about just for a couple minutes is we are coming very, very close to what could be, the Euro crisis 2.0, something that we witnessed in the 2008, 2009 times. And I think Germany and Netherlands, I think, are going to start seeing the financial hit because Italy, it looks like it is basically on the brink of default,
Mm-hmm.
and this was a big part of, so many struggles and woes that Europe faced in 2008, 2009 due to Cyprus, Greece, as well as Iceland, So Italy it looks like so far, on the brink of defaulting. So what you mentioned about this next week being critical, this could be that, domino that knocks down everything. Well, not knocks down everything, but rather something that starts off the chain of events that could start unfolding and start heading out into the American economy, which could start off specifically in Italy defaulting, and then that impacting Germany and Netherlands, which are two of the strongest economies in Europe, and then that creating a wide ripple impact in Europe, and then that sort of, coming into America. So it's just something that I wanted our viewers to pay attention to is if you are watching something for the remainder of next week, remember what Faisal said about the specific sectors, the ETFs. Watch what happens in Europe, and then also make sure you watch what happens in the bonds. Okay? But with that being said, I think that's pretty much it. Anything else you want to touch upon, Faisal?
No, man, I'm good. I think we covered a lot.
Awesome. All right, folks. Again, hit the thumbs up, hit subscribe, and come join the Cryptosomniac Advantage membership. Again, obviously, we've pivoted over to Alpha Trades, but we're going to have that new website up soon. Go to the products page right here, get the Advantage subscription, and I hope to see most of y'all in here soon. All right. Take care and have a good rest of your Sunday.
Peace.